When you look at, individual markets, which markets look like they are potentially ripe for investors?
The big change of the last year, we had the boom markets. We had the Western US, South and West, Phoenix and Austin and Boise. These were all the big boom markets.
Sure.
And they slowed the fastest last year, second half of last year. Denver and Salt Lake and like all of these markets slowed really dramatically last year. Almost all of those recovered this year, but the real strength through that process, through the second half of last year and the beginning of this year, were the central and northeast markets. Inventory never rose in those markets. We had buyers buying those, and I think those are often more affordable, in Ohio and those kind of places where they weren't as far out of whack as affordability got in Austin or even Phoenix. We have investor competition in the same places that we have regular home buyer competition. It's, investors are buying in Phoenix. And then when the rates spiked, the investors stopped very quickly.
Mm-hmm. Has that affected the prices there?
It did, though they have recovered this spring because with almost all of those markets, places like Phoenix and things have recovered. Demand, like supply has fallen. People have been buying the things that are available. There was the top of the pricing came off. So, all of a sudden, if you're an investor, the cap rates got out of whack last July. Then all of a sudden you could see like, oh, I can get a little discount. And now it's back into my buy box. And so they were like gobbled up very quickly this year. Any amount of home price adjustment in those destination investor markets, investors were there with cash ready to compete.
Yeah, that's been an ongoing, theory, and we'll see how it plays out. Obviously, there's quite a bit of distress in multifamily and apartment complexes, which were involved in that space. And even despite the economic issues that surround these properties, the values may not drop as much as we would predict, simply because there's so much demand, so much money sitting there waiting to get deployed.
That's my observation,
yeah.
Especially in the single family, that side of the investor pool. The bigger complexes that have variable rate interest, like those, there's still a lot, I think, of pain to happen there. But nobody who owns smaller properties in the U.S. has variable rate interest, and so every one of those investors has a really good deal. And you can really see that, right? You can see big investors, the big Wall Street investors, stopped most aggressively. The onesie twosies slowed way down. And the middle range investors, the ones that are professional investors, they own 50 or 100 doors, kind of that size company, those barely slowed at all last year.
Yeah.
And so, the professional investors that are, that run that business, they were like, I buy houses and I'm going to keep buying houses. And you could really see that. None of those categories, the big, middle, or small size, none of them were active sellers.
Sure.
Right? They're still holding.
If you have a great rate on your house that you bought during this period, and all of a sudden rates have doubled or tripled or whatever, why in the world would you sell now and trying to get into another house with a much higher rate, right? Like, it just doesn't make any sense.